Hello, everyone. Welcome to a Wolfram Language Design Review about financial data. And last time, let's see, what is the day today? April 8th. Boy, mortgage-backed securities. Okay, famous area. I just had dinner recently with a chap who invented those. Anyway.
Nice. Okay.
Trivia point.
Let me help you understand what we're talking about.
I don't know that it does, but okay.
Yeah, so just a little bit of billing. The two things we want to cover today, I don't know if we'll get to the second one, but the two things we want to cover today, mortgage-backed securities and swap contracts, are some of the more advanced things that we know people want to do. Mathematica, this is aimed more at financial professionals, bankers. People need to do simulations that might include some mutual fund manager type people, but mostly money center banker type people. And some of those people will already have models like this. We want to show them implementations of it to make it easy to get started on those things in Wolfram language, as well as give them models that they can extend for their special use cases and additional things.
We did finish last time this, did we not?
We didn't, sorry, we definitely finished the linear matrix methods. The part we didn't do all of last time was the forward simulation stuff in the Monte Carlo methods part.
That I saw down that down at the bottom here.
Yeah.
Right.
Okay.
Yeah, that's been pushed.
Back testing has been talked about for years. You guys are finally solving that, right?
Yes, we're going to have a bunch of stuff in back testing for next week.
Yeah.
All right. Okay.
Okay, so MBS. So underlying idea here is you don't just have a mortgage, you have a whole pool of them, and you're investing in it like a bond, and all the cash flows pass through from the underlying mortgages to the bondholders. And so that means you've got the complexities of an ordinary mortgage plus the fact that there's all of them in a pool. And you need to be able to understand how these things are going to behave under different assumptions and conditions. The main thing to understand about mortgages, they always have an embedded option of the ability to repay them early, which people often exercise to refinance or because they sell the house. So there's some sort of modeling of how fast the things are prepaid as opposed to just paying as contracted on the mortgage contract. And then there's other things that can depend upon if you want to see about credit losses and simulation of house prices, and there's other things you can add in there to avoid being financial crisis fooled. Anyway, that's where the extra complexity comes from, is their dependence of these things on future interest rate paths and future house price paths. But the underlying basic thing is to simulate a pool of mortgages, paying as contracted with some assumption about how fast they're prepaid. And then you can add an extra complexity for how those things depend on.
Super weird. This just crashed.
We didn't even load the package.
Hold on, I just have to send this in.
Sure.
Restart. I mean, this is not the released version yet, but I thought things like that were not happening. Oh, unless this is the version from today that has some new features.
You're talking about your 15 version, you mean?
What? Yeah, new version 15. Okay, all right, we're back. Let's hope it doesn't crash again.
So you just put that needs if you haven't already.
Yeah, you need the needs at the top. Yes, over there.
Do I evaluate this?
No, please, no. Okay.
All right. What is the relationship between this and date range?
Yeah.
Very first question I thought you were going to ask, but go ahead.
Yes, we know. So this basically date range, it's so this great financial schedule, it should be basically down by date range. I realized only yesterday there is a slight overextension because great financial schedule is a periodic date range, but it happens only on the business date. And so there is no down value that we're looking at. That means that you can ask for.
Wait a minute, doesn't this say holiday calendar? Doesn't this have a way of doing this?
You can do it. There is an option. There is an example, but it's only working on consecutive days and not with a increment.
Okay,
So
look,
There's also
talk
day
to the-
range, which is very similar and created for the first version of the finance platform.
Yeah.
But yeah,
So guys,
basically the
sort this out and
functionality
add
that
the right
Right.
functionality.
Yeah, I mean, date range should be extended to be able to do the thing that we need for create financial schedule. It's just not there yet.
Okay, fine.
Yeah.
All right. So we don't need that.
Yeah, we don't need that. That's true.
It'd be nice if these were actually formatted properly, even in
Okay.
this. I mean, okay.
So they're
Well-
complicated beasts, obviously. So the idea is you can have contract parameters, which are about the specific mortgage-backed security pool, and ambient parameters, which are things about things happening in the world outside of the contract. Usually in the future, like what happens to interest rates over the course of life of loan, that sort of.
Okay, I have a much more basic question.
Sure.
If I go to Wolfram Alpha and I ask it about,
Yes.
a mortgage,
Yes.
I get a bunch of information. We should
Yes.
have that here, obviously.
Yeah. So the mortgage-backed securities, because their pools of them are a little more complicated. The things
I
right now, and
understand.
the things right
Yeah.
now in the language that you want to do with fixed rate mortgages are actually annuity due, which is bad design, but annuity due in the cash flow functions does the things you want for a mortgage calculation. And the stuff on the alpha site is better in the sense that it's tailored to what people normally want to do there. We should have at the very least worked examples in
No,
annuity
I
due.
think we should have it. Listen, look, before you get to doing fancy stuff for quants,
Yep.
right? Why not just have a mortgage object
Yes.
that has, an association that has the properties of the mortgage,
Yep.
and then it
I
has,
agree.
we can ask certain properties. And then
I entirely agree. So the point is that this should just use annuity due underneath, but it should be a wrapper outside of it that's more useful for people.
Right. But I mean, I don't know what this annuity due. Okay. I don't know whether that's right, but I mean that's a low level operation. in some
Relatively,
sense.
yes. It's part of the whole suite of time value functions, which came in a long time ago, that do these sorts of calculations. But you have to do solve of an annuity due for a payment amount to get a fixed rate mortgage.
Yeah,
right?
well, so that's not what we should be doing. We should be just
Right.
doing. So let's get a design for a mortgage object where, the properties of that object, I don't know whether we need functions on that object, but okay. Now here, you're saying, so many of these things here are,
Like 3 or 4 of them are properties of an individual mortgage, and the others are properties of the pool, right? The
Right.
number of mortgages in
and
the
maybe
pool
we
and
should
so on.
separate those because you should be able
Yes.
to take, a mortgage. I mean, I don't understand. The mortgages are not all going to start on the same date, right? This is
No, what they usually do is they release these things with monthly tenors. That is, they're put together by government agencies that have a whole pool of them, sometimes by banks separately, but all the ones that originated in a month or a quarter, right, are put together into the same pool, and they'll have sometimes amount ranges and the same interest rate on them that go into the pool.
okay.
So they're not like a mix of all kinds of different maturities. They're going to be maturities at least very close to each other. Interest rates usually all the same. Although there can be some more complicated versions of that, and the amounts can be mixed, although they're usually in a tight range with an average amount.
So we have the notion of things like financial bond, right?
Yes.
And which presumably interoperates with the stuff you're building. Yes?
You can, but these are more complicated than those for sure.
No, I understand that. But I mean, in the stuff we've just talked about already, like, here, I'm assuming, because we didn't really talk about that, financial options.
These are going to be the empirical options on them, whereas the things that you get from financial bond are all the theoretical calculators of theoretical values rather than the actual market quotes of individual instruments.
Okay, so how do you get a bond as an actual instrument?
You mean
An
as one
empirical bond?
Empirical bond. I mean, we don't have a data provider for those at the moment, honestly. In
Okay,
financial
but
data.
I understand, but we need a design.
Sure, and they would have their own CUSIP and their own, their own ticker symbol effectively, and information about them, et cetera. And yes, that should be on a roadmap, but it's not there yet. They get arbitrarily deep because the more obscure things trade very infrequently. Anyway, the point is that providers like London Stock Exchange Group, formerly Thomson Reuters, and Bloomberg, and a few others are the main providers of information about the actual empirical bonds in the world. Because there's many, many more of them than there are stocks. Because each company has many issuers, and there's also lots of issuers that aren't companies, municipalities, etc.
Okay, but just, I mean, this syntax, for example, is that consistent with what you're doing here for financial options and so on?
Mostly. Some of the conventions, like integer years, are really the more appropriate to the theoretical values than to empirical instruments like maturity dates.
A project, not instant, but at some point, will be to modernize these functions, right?
Yep.
Introduced, 16 years ago. And deal with units, deal with data objects, and so on, which they appear not to be doing right now.
Yep. I agree. And the same is true for like mortgage extensions of annuity due and all that, the time value functions.
Yes. But I mean, in annuity due, you could give it a mortgage object, a symbolic mortgage object, and it could give you answers from that, couldn't it?
Yes, exactly.
Okay. It would be nice to see the design of those things. Why don't you guys just look and see whether you can do obvious generalizations of this? Like, I think this might have been designed before associations existed.
It was.
Right. So, there's a bunch of modernization that can be done on these. Okay,
yep,
let's go back to what you're talking about here. So this is a mortgage-backed security.
Yes.
Oh my gosh, what the heck is that?
So there are part of information that has been stored as meta information inside the tabular object. Tabular object allows to store information as meta information. And right now,
this is crazy. I'm sorry. This is no. Okay. No. I mean, look, no. I mean, you've got a symbolic object here, right? Mm-hmm. It should store whatever meta information it should store. It has a big tabular as one of the elements of this mortgage-backed security object. I mean, not some kind of crazy thing where you're trying to stuff it into some corner of the tabular object.
Okay.
That makes sense?
Yes.
Yeah, I mean, so each of these things, presumably, so I mean, I don't know, what do you call this tabular object? This is an element of the mortgage-backed security. So what you would do is you'd be entering certain, inputs here, and then the canonical form of mortgage-backed security would contain this whole tabular thing that it generated. Is that the right way to think about it?
Yeah, exactly. Yes. I will. Yeah.
Okay. Why are there no units in here for principal and? Oh, they are.
No, there are. It's the way that the tabulars work.
Okay. All right. Oh boy. Really? What the heck is this? Is that part of this function?
The security parameters thing down at the bottom hasn't gone through the design review, but the things down here is just a display function for all the things. The top thing is the main thing you care about, which is all the cash flows over time for the theoretical stuff you're putting in here. In this case, the prepayment speed being fixed.
Well, this is a very special function. I mean, this is not the kind of thing that should wind up as a system function. I mean, in other words, if there's
it's definitely an application function, if that's what you mean. But
yeah, right.
But so, mortgage-backed security plots is one of the display functions that's specific to the finance package.
Well, that may be, but I mean, it's just not a thing that's going to be a top-level system function. I mean, there could be some kind of maybe something, a cash flow plot or some such other thing if there's a general category, or
Agreed. Cash flow plot is something you could use. The fundamental thing here is that you get cash flows in different things, which is like a stack bar chart kind of application of a kind of a stack bar chart, effectively.
Well, what do we do for equities? We have a function. What do we have? What is it called? The thing that plots the candlestick chart or something?
That's a trading chart.
Okay, so we want a general kind of thing for these
cash flow chart.
cash flow chart, a securities chart, or I don't know what. Cash flow chart would be fine. That can operate on an object, just like presumably
On a cash flow object, yeah.
Yeah, like a trading chart presumably can have things in it. I mean, presumably I can give it cryptos, I can give it this, I can give it,
Sure.
maybe I can give it an option, option prices, can I not?
Absolutely. You absolutely can. Right. And anything which is open, high, low, close data with volume is what trading chart is designed to accept. And we could make a similar thing which takes any kind of cash flow object.
Excellent. That sounds like the right approach.
Yeah.
Okay.
Cash flow chart, I would assume will be the relevant.
Yeah, and being understood that with different kinds of things passed in, you're going to have different properties that you're adding together into the overall cash flow, but that's going to vary from instrument to instrument. Yeah.
Okay.
Okay. So one of the fundamental things here is that what do you let vary and what do you just put in a theoretical assumption? So prepayment speed is a conventional model that's used in industry of assuming that people are going to start prepaying their mortgages.
There's no way it's going to be a function called prepayment speed time series.
Okay.
I mean, what is that?
So the idea is how much people will prepay any given mortgage in the pool, right, is something which has a time series character, which can depend upon other things. Here it's being passed in as an argument to the mortgage-backed security, which is going to tell you what cash flows result from it. The simplest case is that that's just following some basic model of based only on the time, but it can also depend upon other things like the changing interest rates when you want to simulate these things. So you need to be able to calculate your prepayment time series separately from a model and be able to pass it in here and be able to map that over this function over multiple instances of what the different things are that could happen to the prepayment.
Okay, so rate. This is a particular model for prepayment.
Correct. This one right here is a particular one that it's fixed. There's another example down below where you let the interest rate vary, where you'll get a much more complicated shape from this. So if the interest rates do that, scroll down slightly, then this is the way the prepayment speeds would go instead. Instead of being that fixed blade that you had before with the theoretical average, that's the blue, you'll instead get the yellow one.
Look, if we're getting into simulate prepayment speed, that's not a system function. Maybe we need to break that off as a function repository function or something.
Okay.
Because there's no way.
It's certainly the kind of things that people need here is to be able to see how they put in the NB parameters.
I know, but if we're going to do this as system functions, it's got to be more general than that. It can't just be, this. Look. If this
I can explain to you the thing which is more general that you might want in other cases, right? Fine. The underlying thing is you've got some driver series that you need to simulate, and that driver series is in turn going to affect some other measure that is part of the thing you need to calculate or simulate to determine the value of something. This comes up with the swap contracts too, right? All of them are going to depend upon a future interest rate or a future exchange rate, that sort of thing.
Which is simulated in some way.
Correct.
Right? Okay, that's exactly what we have random process and things like that for, right? So we have this notion of processes. We have Ito processes. We have all sorts of fancy processes. Yes. And what you're basically saying is you want to have something here, which could be some fixed function like this.
Yes.
Or it could be
a random process.
Function, right?
Correct.
So to me, and you have certain named models for these things. Is that a fair statement?
More or less. I mean, in this case, the thing up above, that interest rate process, is a name process. It's an Ornstein-Uhlenbeck random process on the interest rate, and then how you're getting from that to the prepayment speed is another fixed operation, right? So you first simulate the interest rate, and that's a random process of the kind we already have, and then from that, there's a deterministic way that affects what the expected prepayment speed is.
Okay,
so
yeah.
You don't try to simulate the prepayment speed directly. You get the interest rate that's driving it by one of the known stochastic processes, and then from that you derive what the effect is going to be on the prepayment speed.
Okay, but so what you've got is a simulated financial. We have financial time series, right? Financial time series is an empirical time series, correct?
Yes.
Okay.
Yes, and we have to be able to simulate those for lots of things.
What is financial time series now?
It's financial series without time.
Without time,
yeah.
okay, so could we imagine a family of things called simulated financial series that has all these wacky models in it for different kinds of things?
Sure. Sure. I mean, if we do this a lot already in the Monte Carlo simulations stuff, which we haven't gotten the full review of yet, but where you're simulating a whole family of forward paths, and then you're doing things like valuing options based upon that sample, or you need to do it a lot, and where you're not just getting one of them, but you're getting a family of them.
Okay, fine, but I'm talking about the design here.
Yes.
But if there is a let's say it's mortgage prepayments or something,
Mhm.
and then it has certain, I don't know exactly how this works. Maybe it has certain parameters here, an association of parameters or something. I don't know exactly how it should work, but I'm just saying, let's bundle up. I mean, if all of the simulated financial series kind of work the same way, could there be a simulated financial series of the interest rate? Probably yes.
Absolutely. That's what that forecast thing down here is, right?
Right. But so, rather than having a raw, I mean, let's say that I don't know. I mean, let's say this says interest rate or something. I mean, in terms of reading the code, it would be kind of nice if you say, blah, 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 and then one of the arguments is simulated financial series of interest rate, and then there's an association here that gives the parameters that you're using for the simulation. That seems to me very nice and readable code. That making sense?
Yeah. You're often using data there as well, right? Not just parameters.
Okay. Well, that's fine too. But I mean,
you effectively, find process parameters underneath to fit something to past data and then extend it in the future.
Right. But then as opposed to financial series, which is an empirical data from the real world, right?
Yes. Simulated financial series can be for times in the future or the past of something which never needed to actually exist, but has the characteristics you care about for a financial calculation.
Yes. So simulated financial series. I mean, my question would be, financial series, this would have to have a syntax compatible with financial series somehow. I mean, like you could imagine a simulated financial series of, blah, blah, blah stock or something. See what I'm saying?
Sure. I mean, we do it all the time. But,
Indeed.
Yep.
Indeed. So maybe we have, something like this, and then the dates. I don't know whether that makes sense. And then that becomes, I don't know how you parameterize that, but then that becomes something you can run in a Monte Carlo, so to speak.
Yeah. And this is honestly the stuff that we haven't reviewed yet of the Monte Carlo simulation thing. So there is a bunch of stuff there like that, but simulated financial series is ahead for it as a reasonable idea. We can show you some of the Monte Carlo simulation stuff. But
okay, but then that's packaging up. I mean, I don't know if that unification works to have, all these things. Okay, is the prepayment speed thing a financial series in the same way, or is it something different?
It's a simulated financial series. It can be something where the simulation is, a very simple process as opposed to being a very stochastic process. But yes,
I get it. But okay, it's basically dates and a number.
Values. That's right. Yeah. And how they're supposed to be used. Yep.
Right. But the often financial series, in ordinary financial series, it's usually prices. This isn't prices.
No, in this case, it's a annual percentage repaid per year. Yeah.
Right. But so that's my question: is what, is that going to be a problem if simulated financial series can, represent things other than prices?
I mean, the main thing is needing to be able to go back and forth between the daily changes and the prices in the way we talked about before. There's lots of times where you want the marginal changes and lots of other times where you want the accumulate of them.
Okay, but so financial series is supposed to be able to represent daily changes as well as actual prices?
Yes, it just has a separate thing of, log fractional change as a property.
Okay. I'm a little concerned that maybe financial series should be price series.
The problem is we have enough other things in them as properties of the object.
That aren't price.
Right.
Yeah.
Like you can have a bid-ask channel where there's no trade actually took place. There's no actual literal price.
Yeah, okay, fine.
Yeah.
Okay, but then my suggestion is to try and fit these other things into simulated financial series. See if that works.
Yeah, that does make sense.
Okay.
And then random process and such becomes a way of helping make that simulation, but the thing that comes out is the simulated financial process.
Right. Exactly. So that then that becomes something where the code is readable. In the interest rate, it could have here saying something like model arrow, Ornstein, whatever it is.
Ornstein Uhlenbeck, yep. Yep.
That seems better than having it be this thing which doesn't have units and doesn't have whatever else in it.
Mm-hmm.
Makes sense? Okay.
Okay.
Keep going.
Right. So this is, the case of you've got a particular frequency model and forecast interest rates, and obviously you get a much more complicated cash flow simulation out of it.
Baseline is one word, just small point. Am I making sense?
Yep. Yep.
Yeah.
Baseline. I don't even understand what that might. Okay. This forward interest rates would be a simulated financial series. Is that correct?
Yes.
Yeah.
I mean, you could put in a much simpler assumption, but this is normally going to be a simulated thing.
Okay.
And you can be able to map over the elements of a family to get averages and so on.
Sorry, what a family of what?
So I did the simulation, but I simulated 100 paths, and I want to take the mean, or I want to get standard deviation as over those possible paths. And this function, mortgage-backed security, is calculating what's going to happen to all these complicated cash flows for each of those paths.
Yeah.
But my actual expectation is not just along one of those paths, but I want some average across 100 of them.
Okay.
We're showing here just a calculation for a single one of those where that path is basically fixed, but you can easily have that just be a slot and map over a family of paths.
Okay. Right.
Okay, and there's other calculated things here you want to know about it, like the interest rate risk involved in it, which is declining over time, and how that goes. The next one here, this is an extra complication of not only do you want to have the interest rate simulated, but you could also have a house price simulated. That is average house
another
price.
Simulated financial series.
Correct. And again, there's things where you can have past data on multiple things about default rates and charge-off rates on defaults, and all that kind of stuff. But you're basically just layering simulations of additional processes into the simulation so you can get more accurate accounting of real-world effects.
Okay, but so the basic structure here is the first thing is the nature of this security.
Right, the contract parameters as opposed to the ambient parameters. That's right.
Right. And then the final thing would be, which is maybe a sub-value. I mean, this returning of this is crazy in my view. In other words, the probably. I mean, I would think that you would have that this mortgage-backed security would just be a symbolic thing that just sits there until you ask for some aspect of it.
Yeah.
Isn't that what we're doing with the other financial objects?
Yes.
Okay, so that's what we should do here, not have it return a tabula. That tabula should be something you can get out as a property. Now, we had talked previously about having mortgage as an object, and somehow that this is a bundle of mortgages, so somehow the mortgage thing becomes one of the elements in this contract specification, maybe. I'm not sure if that's right.
Yeah, I mean, you could make a mortgage-backed security out of a mortgage specification plus some extra properties for the number of them and total amounts and so on.
All right. Okay, so that will be a way of doing this, or you could maybe have the raw thing that you're doing here where the actual properties are right there at the top level.
Yes.
Okay.
Okay, and this is just showing the full complication of all the different things you can get.
Okay, I think that the design-wise, this is the same type of story.
Yeah, agreed. Okay, and
charge of ratio path. What the heck is that?
The charge-off ratio.
Oh, charge off. I The code
Sorry.
didn't read. Yeah, charge off.
Yeah.
Okay, I saw it.
Yeah. It's
I
something
don't know what it
defaulted,
is, but
something defaulted, but how much money did you lose on the default? It depends upon whether or not the price of the house has fallen below the amount on the mortgage or not, and so on. So that if you scroll down slightly, you can see the plot of charge-off ratios and delinquency rates.
okay.
This is the kind of thing that they didn't simulate in 2000 and before 2008.
Yeah.
Famously. Okay, so we want to make sure that we have those sorts of things in here. And this is mortgage security measurements is an extra thing you can get about this, which is
I'm not buying this. This is where you get to take a mortgage-backed security object and tweak certain aspects of it and ask results about it.
It's kind of like that. Yes, it's kind of like that. But the what's the thing? If I give you a big tabular cash flow object and I want to ask something like its present value or its future value at time period 10 years from now on the assumption of a 6% discount rate, right? You have to be able to operate on those things the same way you would on a big complicated cash flow object with the time value functions. So that's what this function is doing for you.
Okay,
right?
but then it should just be that function. And James, I'm kind of complaining here because some of this design stuff shouldn't have gotten this far. I mean, these are to have all these crazy functions. Look, if the point here is this thing is basically defining a cash flow, is that true?
It makes a very complicated cash flow object with other features, but yes, it's making a cash flow object.
Right, but so then the properties of that cash flow are generic. That cash flow could be some random annuity, or it could be a
Correct.
mortgage-backed security. So don't have a special function that's about mortgage securities. It should be a thing that can measure properties of anything that is generating a cash flow.
I understand.
That's what
So-
it should be doing.
Which might need to be extensions of time value or extra use cases of time value, but
Exactly. Right.
we're just trying to package them into something which is everything people would want about this. But yes,
Right.
it could make more use
It
of
could
underlying
be
functions.
conceivably cash flow measurements or something, conceivably as an alternative to time value, if time value is too low level.
Yep.
But it shouldn't be specific to mortgages.
Okay.
Fair enough. I agree. Yep, that's a good design point. Okay, and this is just the underlying things. You've already seen them, so we
Right.
should
So this
probably
will be
push on.
simulated financial series.
Right. So we should push on to the swap contracts if we can get there.
Okay, fine.
All right. So this is a similar kind of thing in terms of a complicated thing that people want to simulate. The difference is that these things always have two legs, that's what they call them, meaning somebody is paying something and somebody is receiving something. So in every swap contract, you can think of the leg as what I'm receiving on one side of it. And you have the same kind of issue of needing this depending upon some simulated, possibly simulated paths as well as some contractual things alone. But again, you're getting a cash flow object on either side of the contract.
Right.
Okay.
What is the dependence when you do a swap contract? When you exchange cash flows, you say based on different interest rate structures. What does that mean? What is it actually?
Well, for example, it's like I will pay you fixed rate in dollars, you pay me floating rate in dollars, or I will pay you fixed rate in euros, you pay me a floating rate in dollars. So you can go from one currency to another and from fixed to floating, where fixed means fixed over the life of the loan, typically 5 years, and floating means it depends upon some changing reference interest rate like LIBOR or something.
Yes.
And the point is that a typical swap contract will be either in one currency or two, and then it will be fixed to floating. Fixed to fixed doesn't make any sense, but fixed to floating or in one currency or two. You can sometimes have fixed to fixed in two currencies, where it's just a currency swap.
Okay, so just so I understand, for example, LIBOR,
Yes.
will we have a financial series that is the LIBOR rate?
Yes, it'll probably be something which is like a feed from a service connect from Fred or something like that.
No,
It's just a reference rate.
I'm not asking the implementation. I'm asking the design. The design will be, if I want to introduce the LIBOR rate, it will be financial series of LIBOR. Is that correct?
Yes, if wherever you're getting it from.
Well,
this function,
you're figuring out where we're getting it from. I'm saying for the user who's writing a piece of code where they're trying to figure out something about some swap contract and something is based on the LIBOR rate, they just write financial series of LIBOR to get that data. Is that right?
Yes, but these functions are set up to take that as having already been calculated and being passed into them, right?
Okay. All right.
Um,
Fine. But I mean,
so
but the way you'd pass them in, I'm just checking that it all sort of fits together. That you could write a piece of code that just says financial series of LIBOR, and that would be the thing that you pass in here to get that interest rate.
yes, it should be.
Okay. All right. So, all right. So now, what is the final? Okay. So in the end,
You get cash flow objects on each leg of the contract. Basically, you have a cash flow object on one side and a cash flow object on the other side. But in order to figure out what those are, you may have to specify an interest rates forecast series or simulated series, or a exchange rate forecast series, or both. So basically, you're having something where if you gave it a simulated interest rate path or a simulated currency path or both, then you would get a single cash flow object. But you need to specify those paths before you get down to having a single cash flow object.
okay. So I don't understand why you're specifying swap contract leg. Don't you need both legs?
You do, but you need to be able to. You only get a single cash flow object on one side of it, and then each one calculates the amount that it pays, and then the actual resolution is only the net payment from one to the other, which can change from. So that's something that you want to be able to calculate. You want to be able to say, this leg owes this, and that leg owes that as two little cash flow objects. And then you need to be able to do the sum of them in either currency, right, to figure out
Right,
what
but
the net payments are in each period.
So a single leg on its own can compute things. True or not true?
If it has a path, yes.
A single leg will generate a cash flow object.
Correct. And if it's fixed rate in one currency, it doesn't even need to simulate anything.
Well, fine, but conceptually it's simulating it.
Correct.
Is it simulating two cash flow? Is it going to generate
One.
two cash flow objects or one?
The leg is
every
just
leg
one.
generates one.
Correct.
And then the settling of that is the difference between the cash flow objects of the legs.
Correct.
Or something. Okay.
Correct.
Okay.
So that's what the net payment is doing, is just putting the two cash flow together to get
By
you.
the way, this cash flow object is a pre-time series type thing. Surely we should modernize this.
Yeah.
Yeah, it's fair. I mean, cash flows ahead is older than the modern time series heads for sure.
Right. So I think it should be modernized
We're trying
to allow a time series inside.
I understand. We're trying to be interoperable with all the existing time value functions. So you're right that there's all of those could be modernized.
Well, those things should be modernized. It shouldn't be hard to do that.
Yep.
Okay, but then this generates.
So each one of these is just giving you the cash flow object on one side or the other. That's in the net payment thing. If you scroll down slightly,
Yeah,
is going to take the legs of a swap contract and get you the net payment time series.
okay, but that's a general feature of cash flows. So in other words,
Yes,
if you have two cash flows,
you can net payment and add them together. Yes.
okay, so fine. So then that is probably a thing that we should do as a general function on cash flows.
Right. The only complexity in the swap contract case is that you need to be able to deal with cash flows in different units, right? Because sometimes one side of it is in dollars, one side of it is.
I understand.
Yeah.
So then there has to be some conversion thing somewhere.
That's the whole point. The conversion thing has to be done as a time series, not just as a fixed amount.
Great. So net payment presumably should be allowing, I mean, either you do a conversion, a unit convert. I mean, how does that work with unit converts and so on? Or currency convert rather?
That's the thing is, well, sorry, Filippo may speak to this, but
Yeah.
Go ahead.
No, we are not using unit converts. There is it's a down value that we discussed back in January.
No good. I mean, so what you're going to need is something where currency convert of a time series is capable of doing the right thing.
Yes.
Yeah.
And
by
we
the way,
filed on that.
And
right?
that's something for Nick.
Yep.
Look at this. This should be a data object.
Yeah, the documentation examples should be updated to use data objects. I mean, we need to regenerate these with the newer time series output anyway. So
right, but so this currency convert should surely be able to do that, a currency convert of a cash flow to a different cash flow.
Yeah, and it needs to be able to handle different assumptions, right, about when the conversions happen, if the conversion happens as a whole time series or at the beginning or at the end and so on.
Fine. So
yeah, we run into this with inflation adjustment of, exactly. Are we looking at historical currency conversion rates? Are we doing, when does the the transition between currencies happen versus the transition between dates. Inflation adjust has a inflation method option where you can control custom.
Right, okay, fine. So
Yeah.
then what I'm saying is that currency convert should deal with this. So in other words,
You're
in
right.
this case,
Mhm.
when you either say net payment of currency converter, blah, 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 and it's an error message if the things are in different currencies, or I don't know exactly, or the options to currency convert also become options to net payment. See what I'm saying?
Yeah.
Yeah, they should talk back and forth seamlessly.
Yes, but I mean, in a net payment, one's in euros, one's in dollars. Which one do you get out?
You have to have an option. You have to have an option. Not only you have to have a assumption about how the conversions are done as a time series or with the beginning or the end, but you also have to have an option of which you have to be querying it for the result in euros, the result in dollars.
Well, but I think then it might be easier to just say net payment gives an error if they're different currencies, and you say currency convert of the currency you want to convert, of the cash flow you want to convert.
It's complicated because you have to provide, you have to specify the right amount, the right what am I trying to say? You could easily use a currency conversion option on your cash flow objects here, which would not be the one which you actually contracted for in the swap contract, right? If you're not careful.
Okay, so in other words, the swap contract, but if the swap contract gave a currency conversion, if inside the specification of the swap contract, it gave a specification, then this net payment
Yes.
might be able to just read out those
Yes.
specifications and be
Yes.
happy, and it doesn't need an explicit
Yes.
conversion.
Yes, and they're always
So-
in the swap contract case. They're always doing it, you know, with the changing currencies at each point in time, right? Not at the beginning or at the end.
All right. So
yeah.
Yeah. So fine. So then the third argument here could have the currency conversion function or something like that if it needed to, if that wasn't already specified in those swap contracts themselves.
Yes.
Does that make sense?
Yeah.
Yes.
Yeah.
Okay.
Okay. So this next thing is a utility function for batch processing these, because you often want to do these over multiple interest rate and currency paths, right? And you need to be able to calculate things across an basically you're trying to get an expectation here. So this is similar to the point you made about wanting to have simulated financial series its own thing. If you want to get something which is a property of an object across a whole family of simulations.
Okay. Can we make a prediction here? And James, please speak up. The prediction would be, I'm not going to go for a thing that says net payment
batch process. I got it. Yes, I got that from the part before.
Yeah, right.
Yeah.
Let's
I'm just trying to explain to you why we wanted it, right? But I agree with you. It's not going to be called that.
Right. So what you're fundamentally trying to do is essentially make an. I mean, we've had this in a number of places, maybe even in some previous reviews. This financial data, you're trying to basically create an interpolating function of some kind.
I mean,
by
it's
evaluating a bunch of things.
It's more like trying to get a histogram out, but whatever. It's trying to get a population a characteristic, an average or an expectation. And there's lots of things like, you know, option valuations are such expectations.
Yes.
But so, you know,
so it's basically you have a Monte Carlo, you know, you have a process.
Yes.
And you know, we've got some of these things in the random process subsystem.
Correct.
Where you've got a specification of a process and you want
to know things about its expectations or other properties for sure.
Right. So I don't know that subsystem all that well.
But you're going to copy back testing too, by the way.
Right. So, but I think this is going to be a general thing. You've got a specification of a process, and then you've got a thing that just says, do that process a bunch of times and give us the expectation from it.
Yes. And you want to know not just like the average, but you want to be able to see the histogram of the results across the simulations,
sure.
Standard deviations and what, et cetera, et cetera. Yeah,
right.
Exactly.
So, you know, for example, if we have one of these processes, I thought we had a general random process function. Oh, it's
we have random function is the generator.
Okay.
Mm-hmm.
So is it the case, Scotia, that with random function that you can get these variances and things?
Right, you get the
scroll down slightly, you'll see it. Yeah.
Right, you get the temporal data, and you can simulate multiple paths. And I think when you go to the neat examples, maybe I don't know if on this one, but on Wiener probably we have the histograms that go across to show you the distributions for each time slice. You could get that, yeah. So I think this is what they're talking about. So for if you have many paths, then for each time instance, you know, in a way you could find the distribution of your of your sample.
Yeah, that looks quite nice, by the way. I haven't seen that. That looks quite nice. That's similar to what we are doing in terms of showing histograms of usually at the end for these simulations. Felipe, do we have one of those? I don't know if you have it in this notebook or not.
Okay, but so the design exercise here is let's understand what's done for random function. And let's use the same kind of approach here, where we've got this object, which in this case was a random walk process.
Sure.
Here
I mean, in the case of the thing on the right,
object.
because you've got symbolic versions of the processes, you can often get, more exact answers, et cetera. But in this case, you have to actually,
But there are plenty of cases where we have to do Monte Carlo even on the right.
Correct.
So, I mean, in this case, I'm trying to understand simulated financial series versus.
You need something like the ability to get a simulated financial series being passed into these things, and then need to have some kind of wrapper around the population of them to have population characteristics like expectations, means, standard deviations, etc.
Okay, but basically what we're saying is there's a simulated financial process, which is just the concept of the process, so to speak. It's like it would be like random walk of whatever it is. It's just
but it's not just the concept of it. It could also have the realization of a single path.
Okay.
Right.
Is that true for random walk process also?
Yes, absolutely.
I mean, no. So I think it's slightly different, because what you do in a simulated financial process is said that you do a bunch of simulations and then you average in some way to get the single path. And from this, you want to have from this batch simulation of many paths, you want to have your mean and standard deviation and so on.
And so
right,
on.
But then you want to but in terms of the data, you want to return the simple path, which is your computed path. Yes?
No. The whole point is I very often need the individual paths, even the individual paths with certain characteristics. Give me the 50th quantile path, give me the 25th quantile path, give me the 5th quantile path according to a certain sort or something.
Okay.
Right. So you often need to get down to you need to keep the individual paths to calculate other characteristics of them.
Right. But then you kind of go, but then you go for each kind of timestamp. So you're gonna kind of look at each as a distribution in the sense. And Stephen, you need to do, for example, mean of random walk process, and then you need to say of t, because this has to be distribution, so it has to be at a certain time. So at certain time slice. So you say, I don't know, at time t. In this case, there is a closed analytic solution for that. Mm-hmm.
Okay, so that's the type of thing that you want to do for these financial processes as well. In other words, could we make this work the same way? I mean, mean of simulated financial process of August 14th, whatever it is.
Mean alone won't tell you something, but if you add the appropriate property, then yes.
Yeah. Okay. Fine. But something like that, and then I'm not quite understanding. I mean, presumably there's a way of specifying. I mean, if you're doing something numerically in the random process framework, presumably you can say use 1,000 paths. There's some method
right. So
option
this structure would work for temporal data, right? So if you want the mean on the slice, you have the temporal data. Temporal data on a slice, it's a data distribution, and that behaves like a distribution. And so then you can compute the mean, standard deviation, and so on.
Okay.
The challenge right now is that we have two different worlds.
Slow down.
Because
hang on.
Yes.
We also still have to slow down for a second, right? Because in addition to having the fact that you can do it at different time slices, et cetera, often the calculation that you're doing is not at the time slice, right?
Yes, so, but that's the point.
Let me finish. So this is why you often need the paths, right? So if I'm trying to get a present value, right, I'm discounting at different rates. So I'm doing an intertemporal calculation, basically.
Yeah, you interpolate between the timestamps, right? Because you simulate at certain time points, and then you want to ask for a property at the time which is not at this times that were simulated.
I'm not worried about I'm not worried about the interpolation.
Okay.
I'm just saying that some of the calculations are different from mean in the sense that they are not fixing a time slice and then doing the calculation, but
Right.
instead they're a calculation that puts together the values along the path at different times. And if I map that across this series of paths, that's different from, you know,
Yes.
you have to have each full path to do
Yes,
each calculation and then get your aggregate.
Yes, but then you're talking about the multivariate distributions, because if you take the multi-time slices, you get the multivariate distributions, and then you can have your multivariate properties for
It's still not the same
Yes.
thing, because it's not a matter of there being multiple variables. It's just a matter of needing the entire path in order to calculate some of these measures,
Like
present value,
okay,
right? So
you need to get to the end of the path. Is this what you're saying?
yes,
To get the present value.
You need to have the
whole path.
Yeah, that's right. It's a measure on the whole path, and then you need to be able to do your mean across that measure across the whole path instead of.
Right.
In other
So
words,
the basic point
the
is
order of operations matters, is all I'm saying,
yeah,
right?
the present value of the path, and then you're saying, you know, sort of.
Now I can do that mean.
Yeah, I understand, but the mean across a you know many paths, I'm going to call it here.
Yes.
Of that.
Yes.
Right.
Yes.
And so the issue is, what is the thing? I mean, this path specification.
That's what I think is the simulated. That's what I'm saying. I think is the simulated financial series, right?
Yes.
The path is a simulated financial series.
Okay, so this is that simulated financial series.
Yes. And then present value will take other arguments too, but you can do present value of one of those, right?
Yes.
And that's present value with arguments, and then you can do any of the things.
Okay, but that present value would just be symbolic at this point. And you have to ask for the mean to get the mean of the present values. Is that right?
If I have one path, I can get a present value as long as I give another argument for, discount rate, the other things that present value is expecting.
Okay, but you don't have one path. You have a simulated financial series, which represents an infinite number of paths.
I don't know that that's the case. It's not the way I was thinking of the design. I mean, I was thinking of simulated financial series as being, it's gonna resolve to an actual path.
All right. Okay. So then there needs to be a wrapper here that says something like
my sample equals
path sampling or something. Path sampling, whatever it is. I don't know what the right term is of that. And that then does not resolve until you've got the mean outside. Right. That represents, or maybe it resolves to a temporal data thing. I have to go, guys.
Okay. There's some design stuff to get those work with temporal data and the examples we're showing here.
I think Gosha, Nick, James, you guys should meet without me to go through this, because I think there's a little bit of integration here of random processes, etc.
Yep.
Make sense?
Yeah.
Yep.
Okay.
Okay.
Yep.
Okay. Good stuff. Interesting things. See you all later.
Yeah. Take care.
Okay.